Welcome back to my YouTube channel, Victory Reverse Mortgage. I'm Benny Victory. Today, December 10th, 2022. This is the 10th video that I'm doing in a series that for the month of December, I'm doing one video a day. And today's video is one of the most commonly heard objections and most referred to of the four that exist, and I will go over. And this is what I call the elephant in the room that I mentioned in one of my videos. And I said, when I say the word reverse mortgages, people have an automatic negative response. And without even understanding and without even thinking more about it, they default to their subconscious autopilot. It's a bad product, and then off to the races we go, because then at that point, they're already gone. In their mind, they're already thinking there's no way in hell I'm getting this mortgage. And if you think that you're going to convince me otherwise, good luck with that. So that's the blessing with these videos, is that I get the opportunity to lay out the information, to lay out the facts. And then, I really look to the senior to listen to this. And by not being in front of me, this gives you an opportunity to not feel like you have to put the walls up and we have to get into a situation where you think I'm trying to convince you in person to make you buy something. And again, this goes back to another video that I've done early on, which talks about what you can expect when we meet, or if you were to have a conversation with someone that wants to do a reverse mortgage for you to help you. If they're really professional and they have your best interest, is to determine and to educate and to make sure that you're the proper candidate for the reverse mortgage. I know watching these videos and listening to me, you would think, well, it's obvious, Benny, to you, you do reverse mortgages and everybody should have a reverse mortgage. But that's not the case, because if you and I were speaking and you tell me that you don't see yourself being able to stay in this property because it has 2 stories and you're beginning to have physical limitations of being able to be mobile, well, staying in that home is not going to be good for you. It's not going to be safe for you. It's not going to be advantageous for you. So then we talk about other solutions. But it's the old saying, when you're a hammer, everything looks like a nail. I do reverse mortgages. I believe in them. I know what they can do, but I also know limitations of what the product is. And I understand the limitations of the person that I'm presenting it to in terms of whether it's the ideal product. But we can't get to that conversation. We can't be in a situation where I refer to my videos as you and I are in collaboration. You and I are not in a situation where I'm trying to push my will upon you about how this is the best thing and we're being combative. In that kind of a situation, I'm not winning and you're not listening, and the entire project is at a standstill. So going back to these videos like this video today, if your mental impression about a reverse mortgage is what I'm going to be discussing, and if the reason that you can't see yourself taking advantage of the features and the products and the benefits that a reverse mortgage brings to the table is because of this impression, this can be the starting point where you can now do your own independent research. I'm not hiding the ball, and there's no secrets with the reverse mortgage. The product is now 34 years old, and the amount of research in the last 10 years, the academic research by economists, by people that have done due diligence and written white papers, and incredible people that have really committed to bringing this to the forefront for the seniors, is undeniable. So when I hear someone coming at this product from a place of misinformation, miseducation, and then trying to convince me that it's the right thing to do, then I challenge them and I say, have you read Dr. Wade Pfau's book? Have you listened and read Dr. Salter's information? Have you read this white paper that talks about the benefits of having a standby line of credit. And they look at me like a deer in headlights because they haven't. But they, in their heart, believe that they're on the right place, and then that's it. It just goes nowhere. So the preface to this video is, if you can have an open mind and use this as a starting point to challenge yourself and to be able to get into a situation where you could say, you know, I'm uncomfortable with the concept of a reverse mortgage. When I hear the words reverse mortgage, I think automatically of little old ladies being kicked out by the lender and living in the street. Then this is the video for you, because what we're talking about today is going to give you a foundational and the necessary starting point so that you can get to a place where you're comfortable with the topic. So I know that if I was going to sit in a room and these people were going to be polite and not offend me, and I say to you, I'm confident that I know what you're thinking when I say reverse mortgages. The reason I'm confident is because I know 9 out of 10 people are thinking the same way, because that's every person's conversation that I meet with. Initially, their impression is one of these 4 or all of these 4. And if you really think about it, the 4 biggest objections to getting a reverse mortgage, well, what are they? Let me get my trusty pointer. The bank wants my home. A variation of saying that is that the bank is going to foreclose on the house and I'm going to lose my home. And to this point, I've done 3 videos where I've looked at the subject of foreclosure and a bank from 3 different perspectives, and how much more likely it is, God forbid, as a senior who still elects to have a monthly mortgage payment while on a fixed income, that person is more likely to go through a foreclosure than a senior who has a reverse mortgage. And for those videos, if you watch that, then you'll come out saying, you know what, maybe I need to reconsider this idea that the bank wants my property. And this, I'm going to now approach it from a different angle, which is actually doing the math for you and showing why the bank is not interested, why it's to the disadvantage of the bank to want to foreclose on your house. And that's going to be a video that follows this one. So, but for the angle that I've taken and from the perspective that I've shared with you already, is that practically speaking, in order for anybody to do anything to anyone, they have to go to court to do it, okay? And legally, they have to have a legal theory, a legal cause of action. Well, if I'm the lender, I can't just say I'm going to foreclose on Mr. and Mrs. Smith because I choose to do so, because it's advantageous for me, because it doesn't work like that. You have to file paperwork, you have to have a cause of action, you have to have a legal claim, you have to have a contract that you could hang your hat on and say, look, I did this, they were supposed to do this, they didn't do this, which is why I'm now able to foreclose on their property. And in the videos that I've done, I said one of the factors is that if you don't make a monthly mortgage payment to the bank and you have a forward traditional mortgage, because now you're on a fixed income and your spouse is in assisted living or God forbid passed away, that automatically has a negative response and a negative effect to your monthly income. Well, what's the likelihood of you being able to pay all of your expenses and a $2,000 mortgage when the loss of your spouse's income just took away $1,600 of Social Security? It increases it. Well, that increase can lead to more of a potential for a risk for a senior who has a forward mortgage to get into a foreclosure situation. Now, as a comparison, as a contrast, a senior that has a reverse mortgage doesn't have to make a monthly payment because they're not obligated. That's what I meant to say. They can choose to pay it voluntarily, but they're not obligated to make it. And that's the difference. So you have to assume that everything that the court is going to do or enforce, or someone is going to be able to do, they have a cause of action to do it. So if going back to the idea that you're going to have the four things that are negative in your mind about the reverse mortgage, you're thinking that the bank wants my home, which is saying they're going to foreclose on me. I won't be on the property or the title, which is what the topic is that we're going to cover today. I won't be on the property or on the title. The third one that you're going to think of is going to be all of my equity will be lost because my loan balance is growing and I won't have any equity to leave to my kids. And this objection of I'm going to basically have all of my equity stripped and there won't be anything for my kids, I approached this topic in 3 other videos and variations of it from, again, looking at it from different perspectives, because to me, unless you're able to see the same problem from multiple points of view, you're not going to be able to have a 360 view. And the 360 view is what you need when you're going into retirement. It's not just linear when you just look at the problem immediately in front of you. To me, you have to be able to see underneath it, you have to see behind it, you have to see the consequences, you have to play chess. When you're playing chess, you're not looking at your next move, you're looking at your next 3 moves and your opponent's potential 6 moves. And that's what it requires. And that, to me, is what a good advisor is supposed to do for you, whether they're a financial advisor, whether they're your attorney, whether they're your CPA. You're going into a situation where with retirement that can be between 10 to 25 years. And if you can't see all the steps ahead of you, if you can't be looking at the potentiality of issues, then that person is not helping you. That person's guidance is of little to no value to you. Okay, so this concept of equity losing and balance stripping and all of that, I did an entire video that I'm trying to post, and it's actually an hour long. And it goes into the credit approval requirements between what you have, which is a traditional mortgage, and a reverse mortgage and its credit approval. And in the process, I break it down systematically. And I get into the details and the weeds of what the difference between having a reverse mortgage in your retirement is compared to a traditional mortgage, and why I'm such a big proponent of the reverse mortgage and the mechanics of it from a lender point of view, from a bank approval point of view in the future. So this topic, number 3, the 3 videos that I've done have covered this, and I'll probably end up doing other ones if different variations of it come up that I think will be beneficial. But this topic I've already covered, okay? And the 4th objection you're going to have is going to have to deal with the cost of it, because as soon as I say reverse mortgage, everybody gets, flustered and tosses their hand up and, runs out the room screaming that he wants to charge $25,000 to do a reverse mortgage for me. He must be out of his mind. Well, there is the concept of throwing the baby out with the bathwater. Okay, you got to understand, first of all, that the costs that we're talking about, there's the lender fees, which even in a traditional mortgage you pay. There's escrow fees, which again you pay. And there's title insurance, which you pay in a forward or a reverse mortgage. The difference with the reverse mortgage is that there's an FHA requirement to purchase mortgage insurance premium, MIP. That mortgage insurance is not a bank fee. It's a fee collected and forwarded to FHA, which regulates and governs the reverse mortgage along with HUD, the Housing and Urban Development, to purchase on your behalf mortgage insurance. And if you don't understand the concept of having this mortgage in place and the benefits of the mortgage insurance in place, then if I said to you something like it's going to cost $15,000, automatically what are you thinking? You're thinking Benny's asking me to reach into my bank account and write a check at the end of escrow to give him $15,000 just to have this mortgage insurance premium? Absolutely not. But that's not the conversation we're having. I'm not asking you to reach into your pocket and to pay $1 for the mortgage insurance. Okay? And if you don't fully appreciate and see there's at least 10 different benefits to having this mortgage insurance in place, and how it affects you and how it impacts in a good way your retirement, of course you're going to be upset. Of course you're going to sit there and say, he's out of his mind if he thinks I'm going to pay that much money for a reverse mortgage. But see, nobody sits down and explains to you and goes over the details and gets into the weeds about why you need mortgage insurance, what you're getting with it, who's getting paid by it, who's getting the money as a result of it, and is there even any money coming out of your pocket? So collectively, the reason I'm challenging you to these four notions is that behind each one, there's a bunch of facts behind it. And if you stop, if I say reverse mortgage and I trigger you, and the Pavlovian response becomes automatic and your subconscious kicks in and you run out the door cursing me, well, you're never going to understand that you need to have a legal claim, a cause of action for the bank to be able to take your home. You're not going to appreciate the fact that this old history of being off title doesn't exist anymore. You're not going to understand how equity works. You're not going to understand the reverse mortgage basics. And you're going to put yourself in a position where if you're thinking the reverse mortgage alternative in your life is going to be when you pay off the mortgage, you're going to run to the bank and they're going to be like, oh, Mr. Jones, come to us. We'll give you a toaster and a $300,000 line of credit. And we're so happy to see you. That's a pipe dream. That's not happening. Okay. And if you don't understand what the costs associated are and all you hear is $25,000 and you're triggered and your automatic fight or flight response becomes in and you want to punch me with your fist or kick me with your cane, well, you're not looking behind this. And that's what we want to do. Okay. So today's topic is that you believe that you won't be on the title to the property and you are going to be in danger. And I respect this. I understand where this is coming from. And I've done a video about this topic a long time ago. But the nuts and bolts of it is that the dynamics have changed. And the reason that used to be the case, the reason that a person was taken off title, usually the younger spouse, was because of the fact that, let's say, for example, you have a 75-year-old husband and you have a 65-year-old wife. Well, based on the age of the wife, who was 65, the reverse mortgage would allow less money because the 65-year-old wife who's going to stay in the house is going to have longevity more so than the husband who's 75. So unfortunately, the bad habit of loan agents became, because we want to make it look attractive and we want them to do the loan, what we're going to do is we're going to do the loan under the husband who's 75, and we're going to take the 65-year-old wife off title. Well, what happens with that? Well, the person who's older, when they're 75, there's a greater likelihood of that person passing away. Based on insurance actuarial tables, you look at it, a 75-year-old has a greater likelihood of passing than a 55-year-old. Everything being the same and no health issues and nobody running into a bus. So when the 75-year-old husband passed away and the 65-year-old wasn't on title, it created a whole host of problems in terms of now the bank comes in and says, okay, look, there's nobody else living in the house. And the wife is like, I'm still living here. And the bank's like, wait, you're not on title. And she's like, I am on title. No, you're not, because somebody took you off and they misrepresented. And because of these things, because of these bad traits of some of the agents, some of the bad laws that were in place regarding reverse mortgages, there was an overhaul. And that's why I say to you that in the last 10 years of the reverse mortgage, it's a completely different product. Some of the other bad features that used to exist, that doesn't exist with the reverse mortgage, has to do with, for example, there was no financial analysis done for the borrower. They would find out that the person is able to get $200,000, $300,000, and they wouldn't look at the fact that this person is consistently and habitually late with meeting their credit obligations, whether it's taxes, whether it's insurance, whether it's homeowner's insurance. So they would just give them a truckload of money for $200,000, $300,000, and that person not having in place the checks and balances to protect themselves would go and blow all this money out. And then when it came to do property taxes and insurance, they didn't have any money to pay it. Well, even if you have a regular mortgage, a traditional mortgage, and you don't pay property taxes and insurance, you're going to get in trouble. Even if you don't have a mortgage on your house, and you don't pay property taxes and insurance, the state, the county is going to have a problem with you. Okay, so some of these things were reverse mortgage issues, and they've been addressed. And one by one, the problems that used to exist don't exist anymore. So when I say you're going to be off title and the person shakes their head, I know where it's coming from. That used to be the case, but that's not the case anymore. So having laid out the furniture on this stage of what we want to talk about, and we talk about these being the 4 objections that I know are key, now we need to kind of get into the details, or the weeds as I call them, to really understand what the players are, who's doing what, and what each obligation assumed by a person is. Because this goes back to this idea that I said to you, that unless you have a legal cause of action, unless you have a legitimate claim to be able to say, look, I promised to do this and this person promised to do this in return, then I can't say anything when you don't do your part, because I haven't established what your part was. So whether you get a traditional mortgage or a reverse mortgage, these factors are going to be the same. You're going to have the same players. And who are the players? Well, if you're getting a mortgage for your house, this is not going to come as a surprise, because you're old enough that you've bought homes, you've done refinancing. There's a bank. Well, what does the bank do? The bank is the lender. The bank is the money guy. What do? Well, they lend money to the borrower. And how do they do that? And I've done a whole different video, and that's one of the videos that I said to you, it's really important to you. It's actually one of a 3-part series. And it has to do with what the underwriting guidelines are when a bank decides to make a loan. And with the traditional loan, what you're used to doing is your credit has to be excellent. There's a credit analysis. There's your monthly income. How much money is your job paying you? How much money do you have in reserves? What's the loan to value that we're going to go to? What's your debt to income ratio? In other words, you have a housing expense and you have the rest of your life and the costs associated. How much money are you going to have in reserves so that if there's a situation and you lose your job, you don't go belly up and that there's $200,000 sitting in the bank? And the reason I went to that detail on that video and a series of those videos is because, again, for some people, they're thinking that if I don't get a reverse mortgage, my safety net is going to be, I'm going to go to the bank and I'm going to say, I'm 75 years old, I have a $1 million property, it either has a $100,000 loan on it or it's free and clear, I have an 800 FICO score, and I'm receiving $2,000 a month, $3,000 a month for Social Security, and based on these criteria, I want you to loan me $300,000. Well, the bank is going to use these criteria that I've done and I shared with you in that video and just a moment ago to determine how they're going to be able to lend you $300,000. Yes, your loan to value ratio is going to be very low, only 30%. You have an 800 FICO score, fantastic. But the problem is that in paying off your mortgage, now you may only have $20,000 in the bank. And even if you have $100,000 in the bank, your monthly source of income is very limited. And when the bank is underwriting its guidelines and looking at your other expenses, they're looking at your taxes, they're looking at your property maintenance, your insurance, your credit card debt, your whatever other expenses you have, they're going to have to put this DTI, debt to income ratio, into a formula. And if that formula doesn't work, then you can't qualify for the mortgage. And then the other issue is that let's say you do get qualified for a $300,000 mortgage and you get the money. Well, that mortgage has a monthly payment, and that monthly payment is now going to compete with your other income obligations that you have and with the monthly income that you're receiving. And that's what it's important to understand, why you can't just assume that if you don't get a reverse mortgage, your path is going to be the right path. So we're talking about who are the parties when you get a mortgage, whether a traditional mortgage or a reverse mortgage, and what is the role and obligation of each. We just established who the bank is and what the bank does and how they do it in their credit underwriting. Well, the bank is the lender of the money to the borrower. How do they do this? Well, they do this in two ways. First, they underwrite it. Then they say, look, we're going to have you, the borrower, sign a promissory note. A promissory note is a legal contract. It's a legal obligation. It's an agreement between you and the lender. It's an IOU. And the terms of the promissory note do what? Well, they break out your obligation as a borrower and the bank's obligation as a lender. The bank says, look, in this example, I'm going to lend you $200,000. And the loan amount is going to be $200,000. The interest rate is going to be 4% for the life of the loan. So it's going to be a 30-year fixed. I'm going to lend you $200,000 at 4% for the next 30 years. And we know that the monthly payment on that is going to be $954.83. And you're like, hey, I can live with this. This is cool. I'm 55 and I'm getting a 30-year mortgage and I'm not going to retire till I'm 68. And by the time I get to 68, the loan is halfway done. And this is fantastic. I'm working and I need the tax deduction. Let's go. So the bank says, okay, so if you're okay with these terms that we're talking about, now what we need to do is we need to make sure that if something happens, we can make our money back on how much money we're loaning you. We're loaning you $200,000 and 4% for 30 years, but the bank also knows that in 30 years, the amount of money that they're going to get is not going to be $200,000. At 4% at $200,000, the amount of money that they're going to get in interest on top of the $200,000 could be like $130,000, $140,000. Okay, so the bank says, given how long we're talking about between you and I having this relationship, which is going to be 30 years, we need to have some sort of a security. We need to have some sort of an assurance that if something were to happen to you, we could get our money back that we lend you. We're going to forget about the amount of interest you haven't paid, but we need to at least get our initial capital back from the collateral. Well, what is the collateral? Well, the collateral is the house that the bank lends on. So you agree with that. You're like, well, I understand that. Okay, so what the bank is going to do is the bank is going to say, we're going to have a trust deed or a deed of trust, and it's going to secure our interest against this property. And you're like, okay, that sounds cool because I'm not planning on defaulting on the loan. I'm just going to continue making these $954 payments for the next 30 years. And then when I reach the end, I'm going to have the house paid off and the house is going to be mine free and clear. And you're going to receive your money plus interest. So I get it. Everything is great. Okay. So you as the borrower, what are you doing? Well, you as a borrower, you have voluntarily agreed to assume the terms of the promissory note, which is this IOU to the bank. What else have you agreed to? Inherent and understanding it consciously that when I agree to the contract to the terms of the bank, which is the promissory note, I agree to make monthly on-time payments to the lender. This is your mortgage payment. There's no big secret here. Okay, I agree as the buyer, as the borrower, if I'm buying a house or if I'm refinancing the house, the borrower, I agree to pay timely property taxes on the property so that the property doesn't go into foreclosure by the county or the state. Now, in some situations, some borrowers say, look, I don't want to deal with that extra monthly payment. Why don't we set up an impound account for me so that in addition to this $954, I pay an extra amount of money that you, the bank, then on twice a year basis, you pay my property taxes and you pay for my insurance. That's your way of saying I will budget an extra couple $100 a month on top of my mortgage because suddenly I don't want to have to pay twice a year a separate $3,000 tax bill. And that's perfectly fine. And then you also promise to say, I'm going to maintain the residence and I'm going to have homeowners insurance on it. Well, why are you doing that? Well, that's one of the bank requirements. What does that go to? That goes to the idea that if the bank is looking to the property as its collateral, as a security, well, of course the bank is expecting you to maintain it. They don't want, the roof to be leaking and to fall in. They don't want the pool to be cracked and flood the living room. They don't want the house to catch on fire accidentally and then they have no money to go after, because they're entering into a 30-year marriage with you. And of course you want the security. Why wouldn't you? So you say, I'm okay with this. I'm okay with the promissory note. I'm okay with you having an interest in my property, and I understand my obligations, and this is what I'm going to do. The third piece of the conversation is the home. Well, the home is your residence. It's also the collateral that the bank lends on. Well, the collateral that securitizes and protects the bank's interest, okay, it's a financial interest, and that's why you have insurance on it. That's why the bank has the protection, so that if you don't pay, they have the ability to go collect on it. Okay, so if you think about in terms of appreciating my artwork here, this is your home, this is the residence, and it's the subject of the loan and what the bank is giving you the money on, the collateral. This is you, the borrower, borrowing the money from the bank and agreeing to these terms. And this is the lender giving you the money and putting a trust deed or a lien on the property. Okay, so none of this that I'm talking about should be foreign to you, and it should be very common sense. The reason I'm painting the picture and the reason I'm going into it is because this is the framework that we need to have when I come back and do another video on this concept of the bank wants my home, which is another way of saying the bank is going to have a foreclosure against my house and throw me out of the house. Because if you have this as a framework, when I get to this and I discuss this from yet another point of view than the ones that I've done already, which has to do with the financial aspect of it, it's all going to come together. These videos are intended to be layered. It's like you're doing a mosaic, and I give you piece by piece. One piece talks about the legal interest, one piece talks about the financial interest, one piece talks about your obligation to the lender. So these pieces, when the library of these videos grow, then you'll be able to see kind of a bigger picture. It's like me trying to show you a puzzle, but only showing you 5 pieces. Well, you're not going to have an easy time figuring out what the ultimate picture on the puzzle is going to be. But as these videos talk about these topics on a different level, from a different point of view, then you begin to see the global picture that I want to get, which is going to not make you feel so uncomfortable with the topic of reverse mortgages, and it's going to give you the familiarity so you could walk through this and be like, oh yeah, I remember when he was talking about this, I get it now, or I looked into this and it's exactly like he says, and I don't have to worry about now. So when you really think about this aspect of it, it's a very simple transaction. You have the bank, you have the borrower, and you have the home. Well, why doesn't the bank need to be on title? And they don't need you to be off title. They don't need to be on title because they have a trust deed or a deed of trust which protects their interest. And what else do they have? They have a promissory note. And what does the promissory note says? Promissory note says that you, Mr. Borrower, you understand that you have a monthly obligation to pay us this $954 for the next 30 years. And if you don't do that, you're in violation of our agreement. And violation of our agreement means what? The bank wants my home. Based on what? A legal claim. Legal claim of what? You're in breach of your agreement. What agreement? The promissory note. Because remember, the promissory note you signed 10 years ago said you'll pay me $954 a month, but for the last 6 months I haven't been paid? Well, what does that mean? Well, that's one of the triggering events to foreclosure. Because if you watch the other videos that I did, I said foreclosure comes about as a financial issue, which then becomes a legal issue. What causes foreclosure? Well, foreclosure comes when you don't make voluntary mortgage payments in violation of your promissory note. Foreclosure occurs when you refuse or can't or are unable to pay your property taxes on a timely basis, and then the bank has to protect itself and step in and pay the property taxes on your behalf to the state or the county, okay, and if that goes on long enough and they see that you're not able to pay the monthly payment on the mortgage and they're not able to get some sort of a payment arrangement, well, what are they going to do? They're going to exercise this trust deed or deed of trust that they have against your property, because what they don't want to do is let things go and then have the county come and foreclose on you, which the county can, because the county hasn't been paid property taxes and insurance. So they want to get as much of this $200,000 that they have lent to you back. Well, the only way they could do it is by showing that you were unable to sustain and maintain and keep your promises on your side of the property, on your side of the deal. Well, what's the third one? You didn't maintain the property and you didn't have the necessary home insurance on it, and the lender, the bank, finds out that the house is being basically destroyed. And again, why is the bank concerned? It's the lender. And it's the lender, and it has a trust deed or a lien to protect itself. So I'm trying to show you the different aspects and get into the different corners of this, because if you see this, then you understand the bank doesn't need to be on title. The bank's protection comes through the promissory note and the trust deed, which you as a borrower, you voluntarily agreed to, and you assumed these things. Now with the reverse mortgage, it's all of the same things. It's the same conversation, except with the major difference of what? The major difference being that the bank now doesn't expect you to make mandatory monthly mortgage payments. And that's a big benefit to you when you don't have to make that mandatory monthly mortgage payment. What's another protection that the reverse mortgage gives you? Well, that's one of those expensive costs that we talked about that we haven't got into to break it out and to really explain all the features and benefits that you get with the reverse mortgage. But with the reverse mortgage, if it's an FHA product and you get the private mortgage insurance, that has a whole host of benefits that come in and affect this entire transaction to your favor, also to the bank's favor. And it's like the old saying, happy wife, happy life. When the bank is happy, you're happy too, because you're not likely to have these issues when you have a less of a mortgage payment. So today we started this, and we're not going to finish it till we talk about the financial implications as is related with the promissory note and what this turns out to be, and why the bank's interest is really what the bank. Let me get to the punchline of this so that you don't sit on suspense. The last and absolute worst scenario for the bank, whether on a forward mortgage or on a reverse mortgage, is to foreclose on the homeowner. And I know a lot of people sit there and shake their head and say, no, that goddamn greedy bank wants to get my house. I know they do. No, they don't. And I'll tell you why. Because when we do the math and I show you that on this $200,000 over the life of the loan, which is 30 years, the bank is going to get the equivalent of, I think the numbers turn out to be $130,000 of interest. So it's to the bank's interest for you to continue living in this property as long as possible and to take you to the finish line so it can get the most amount of money on its interest. If the bank throws you out in 5 years because of these issues, which are triggering events, which are violations of the promissory note, and the bank executes its deed of trust to foreclose on the house, and it doesn't get that total interest and it only gets $30,000 worth of interest, the bank is going to have to spend money in legal fees, in court costs, to pay a realtor closing commissions and expenses to foreclose on a property. And ultimately, if the property is, let's say, sold for $1 million and the only mortgage against it is $200,000, people have this misconception that the bank is going to keep the other $800,000. No, it can't. If I owe you $200,000 and I lose my job and I can't pay you, and you sell my house for $1 million, you're not entitled to the rest of it. You're entitled to how much I owe you, which is the $200,000, and a reasonable amount of legal fees and expenses. That's all the court's going to do. Okay, so it's not to the bank's benefit, and it's detrimental for them to start foreclosure proceedings. Will they do it if they have to? Absolutely. Okay, and that's a given. So I wanted to really be clear on this, and I did another video and I used the example of a car, and I want to bring the point home for you. So today I brought my little dream car here with me. For the purposes of this illustration, I want you to assume that you're a car dealership. I come to you and I say, you know that red Mercedes on the lot, I want to buy it. And you say, not a problem. And it's $100,000. So I don't have $100,000 to put on the table, and you're not going to trust me to pay $100,000 every month for the next 5 years, or towards the $100,000 in the 5 years. So I fill out a credit application. You give it to Bank of America's auto loan department. Bank of America looks at my income, my credit. They say, you know what, Benny, you need to put 20%, and I put $20,000 down and I finance this car for $80,000. They say it's going to cost you 6% a month, and until and unless you pay off this car, we're going to keep the title to the car in our name, meaning the Bank of America, because Bank of America has already written a check to you and paid off your $100,000, so you're out of the picture. Well, I'm driving this car 6 months in. Well, what do I automatically know? That every month I have to pay monthly car payments, not mortgage payments. I have to maintain the car. I have to take it in, get the oil changed, make sure that everything is running good. And what else do I know? Well, I need to have insurance so that if somebody ran into my car, or I ran into somebody else's car and I damaged this car, the insurance would kick in. Those are all the same things that we're talking about here, except the lender is now having an interest on a car and not on a home. And when I make all the payments, the bank sends me what we call a pink slip, which is really not pink anymore. But they'll send me a pink slip and they'll say the car is yours, and on that $100,000 over the 5 years, they probably made another $40,000, $50,000 worth of interest. Now, what's the other alternative? I lose my job, God forbid, I'm not making any money, and I haven't made a car payment for 4 months. Well, if you're the lender and you're expecting $1,500 a month car payments, and you haven't received this money for the last 4 months, aren't you going to get nervous? Of course you are. You have the legal right to come and do what? Repossess my car. Well, what's repossession of a car? It's a foreclosure of a home. It's the same thing. In other words, what I'm trying to show you is you already know and are familiar with these concepts. They're just a different thing. In a car, it's a repossession. In a house, it's a foreclosure. In a house, it comes as a byproduct of not making a monthly mortgage payment and paying your property taxes. For a car, it comes as a result of not paying monthly payments on your car payment and not having insurance on it. It's the same thing. But if you're familiar with this and you really were struggling with the concept that I don't want to get a reverse mortgage because I'm not going to be on title, I went into so much detail here for you to understand that the bank doesn't need to be on title to exercise its rights to collect on its collateral, which is its house. And you don't have to worry about it because that's not the case anymore. And you're welcome to do the research and you'll find out exactly that that's the case. So the next part of this dealing with the elephant in the room, because we've already talked about this equity stripping and all of that, and there's enough videos on that topic, because I talk about the loan to value feature, the age of 3 possible candidates who are getting a reverse mortgage and how much money they're going to be able to get and what type of a payment pattern there is. The glide path is completely different than a forward mortgage. So I've covered this, and unless I can come up with some additional information, a different variation, this is pretty much covered. What's left, we pretty much beat this to death, and now you've got all sorts of angles to understand it. What's left is doing the math around the bank's interest to not exercise its foreclosure rights and to take over the property because of its financial benefit to continue receiving mortgage payments. And that will be the next video we're going to do. And probably the biggest one, which I really need to get into the weeds and flush it out in different ways, is this cost thing, because more and more people simply come up to the conclusion that with a reverse mortgage, it's so expensive that it's cost prohibitive and there's absolutely no benefit to it and the alternatives are better. So I hope that I know these videos can get a little lengthy. I'm actually surprised sometimes when I look and I see, my God, I talked for an hour straight. But this comes from a place of trying to educate and put the benefits in front of you so that if you have to make a decision, you make the right decision and are not triggered and are not reactive. And here's the problem. And I just was watching a financial advisor, and several financial advisors are now getting on the same bandwagon, which is the coming years, the tax rate is only going to have to increase given the overall national debt that we're running into, the amount of entitlement programs that we have. Social Security just announced the amount of increase that it's going to pay, and the number of baby boomers that are coming in and relying on Social Security as a benefit. 10,000 seniors are turning 62 per day. And that's supposed to continue, I think, till the year 2030. And if you think about the staggering number of seniors that are coming into the system and dependent on this money to help them, to alleviate their financial stress, because what we do know is that there's not enough savings that have been saved. Their debt that they come into, seniors that are coming into retirement, is significant. I alluded to this when I said, when I sit down with people and they have credit cards that are running at 30% monthly interest rate and their houses are not paid for. If you're a senior and you're 65, 70 years old, and even if you have another 10 years left on your mortgage, do you really want to be making monthly mortgage payments till you're 80 years old? And then what? When you get to 80 and that's your finish line, how much money is going to be left for you? That's the longevity risk. What's the inflation cost going to be for the next 10 years as you have to make these monthly mortgage payments? $954 is not much when you're working, but when your Social Security is $1,400 and you have to pay $954 of it towards a mortgage payment, that's greater than 50% of your monthly income just on this. This doesn't include taxes, property insurance, home maintenance, the soft costs, which are electricity, gas, Department of Water and Power, utilities, internet, and then there's your personal living expenses. The cost of you being able to go out to dinner, the cost of you having new clothes, the ability to pay for in-home care if you need it. And I haven't even touched about all of those. So the reason I keep beating the drum to reverse mortgages, we're dealing with a crisis of seniors coming into retirement unprepared, and as a society, we don't have the resources to support them. So if you don't have your biggest housing wealth, your biggest single asset that you do go into retirement with, helping you to offset all of these things that we're talking about, where's the benefit of having a house? Now, if you say to me the house is my shelter and I need to have a house, guess what you get to have with a reverse mortgage? Nothing changes. With the house, with the reverse mortgage, you still have the housing shelter. Except what? You don't have to worry about this monthly mortgage payment that you're paying in this example, or the one that you're paying. if you qualify and you could get into a reverse mortgage, why wouldn't you? Why wouldn't you? Well, because you're terrified of these 4 things. But if you don't get triggered, if you don't have this response where it's subconsciously and consciously, you check out as soon as I say reverse mortgage, and you actually say, I'm going to hold back, I'm going to listen, I'm going to learn, I'm going to get educated. Don't even come to me. I mean, you don't have to come to me to do the mortgage, but have somebody help you. I mean, why struggle? That's the frustrating part to me. Why struggle? Look, you don't have to struggle. If you think you do, that's the starting point of where you need to reimagine these things, these 4 triggering factors in your mind. All right, off the soapbox, and it's Saturday. I need to go enjoy the rest of my day, but I'm committed to doing 1 video a day for the 31 days of December, and this is the 10th one. Thank you. If you made it all the way to the end, I swear to you, you get a gold star. But I hope you understand that I come from a place that I care about what I do and for the people that I do it with. I wish you the best of luck with whatever decision you make, and I hope that your retirement is a beautiful and blessed one. But take the time to incorporate and use this information and see what the alternative looks like. I'll see you in the video that comes up hopefully tomorrow. And thank you for being my client. Thank you for being potentially my client. And God bless you. I'll see you in the next video.